but not far enough off the highs to make the radar of Mr. Alan Nuttman, who likes to buy companies that aren't up 1,000%, is one way I would describe your approach, Alan, Chief Market Strategist at St. Paul Research. Let's talk about the overall market, Mr. Nuttman, firstly. As we see VIX come down this morning, equities bounce back. What do you make of the action so far?
I think we've seen this before a couple thousand times in the last decade. What my focus is right now is the earnings season have come to an end. 96% of the S&P stocks have reported, and we had 79% beat on EPS and 74% beat on revenue. So that's amazing. That's 3.9% blended growth for the quarter. So it comes to fundamental facts. I know that's not how I trade, but that's very, very supportive of the stock market at this point.
Okay. So we see the sharp move bounce. We're only about 3% off the highs for the S&P, Alan, but it was a pretty dramatic 3% given everything that was happening in bonds. You generally take a approach that's agnostic to the why, correct? So I take it you're probably not impressed by volatility, whether it's in stocks or bonds.
Well, I like to see how it reacts. And what we saw with the VIX was the VIX rallied up to whatever, 32 or so. So the halfway point is 26, and it's now back below that. We've seen that over and over again, that it gets whacked back down whenever it pops up. Now, let's talk about bonds, because I'm an old bond trader, all right? Now, the bond market has really overextended itself as far as its concerns about rates rising. I mean, we rallied from 0.5% to 1.5%, all right? The midpoint of the last decade of 0.5% to 3.5% in the 10-year note is, still a long, long ways away. I mean, we're at extremely, extremely low levels. It's almost the same thing as we saw in 2018. Remember, we temporarily got above 2%, and everybody thought that the bond buying was going to get shut down and that rates were straight up from here. I don't see that happening anytime soon. And I think the market overreacted, and we're seeing some people buying value right now.
Okay. So, Alan, overreaction in bonds from your perspective, and maybe then a proper balance today for equities, suggesting that maybe they can either work their way through a 1.4% yield environment, or that maybe that yield is done soaring. You're looking, Alan, at some of the commodity-linked stocks. You're looking at U.S. Steel. We've talked about this one before. The company had a really, really big run as the commodity boom basically what was underway from the summer into this year. But steel has slowed down, even though copper and crude and some of the others are still rocking. What's going on here?
Exactly. You're making my point for me. So steel rallied 400% off its lows. And right now in 6 weeks, it's 25% off that top. So if you look at the range, it traded between 15 and 25 for the last 3 months now. So I'm leaning on that 15 level. But let's get back to some of the other ones. Freeport-McMoRan had the same run up, backed off about 20%, and then rallied, made new highs. Alcoa had done the same thing. U.S. Steel hasn't done that comeback for commodities just yet. So from a risk-reward standpoint, I love this setup. A breakout of this range targets 35. Now, this stock was at $50 in 2018. It went from $50 all the way down to $4. So I still see a lot of upside, and I love it at this 25% or more discount that it sits at right now.
Okay. So you like the discount in the stock relative to what itself, Alan, where it's been? I mean, does steel need to always trade at $25? That was a pretty powerful move. And it was also, kind of precedent to this whole notion of, looking at different markets that were maybe out of favor, vertical moves, investors piling into shorter companies. I mean, it wasn't quite the same, but it was kind of a tangent to that.
Right. And this is a stock, if you look at that 15 level, I am excited about leaning on that. So I'm looking at a $14 call for May. Now, because the volatility has increased a little bit, I'm buying more time than I typically do with my smart money plays. Somebody has a very favorable opinion of U.S. Steel, and that's reflected in the options market. So I'm looking at the $14 call for May. It's trading for about $5 right now, and it's $4 in the money. So it's like being long from 14. I've got a delta of 80%. I've got almost 3 months of time. And if we get just to the top of this channel, the top of this range, this option will double in value. So I've got some time. I've got a solid support point to lean on, and I've got the macro picture because as I always say, it all comes back to commodities.
Okay. All right, Alan Nuttman, thank you, sir. It all comes back to commodities, but it also comes back to bonds, like the commentary.
Bonds are a commodity.
Hey, Alan, I don't get it. How can you not be a fundamental guy, but you came from the bond world? Isn't that what it's all about? Maybe not back in the day.
I was a trader. That's it. I know how to trade.
Okay. All right. We've noticed.
I can't read.
Okay. Appreciate it, Mr. Nuckman. It looks like you're back in Chicago, over 25 degrees, and Mr. Nuckman has come back to his home city. Appreciate it, Alan. Always good to catch up here with
Thanks,
the
Oliver.
Field Trade, Chief Market Strategist at St. Paul Research. When we get back, let's continue that bond conversation. Checking in with Jim Paulson. Last time he was here, he was making the case for BTC.